The phone call comes from a number you don't recognize, not a call center, a direct line. The voice uses your name before you give it and introduces itself as your relationship manager at the private banking division and asks if you have 30 minutes this week for a conversation at your convenience. You have been a customer of this bank for 11 years. You have never spoken to a relationship manager. You have never been offered a conversation at your convenience. The balance crossed $5,000 on a Tuesday. The call came on a Thursday. The bank was watching the number. It always was. The checking account costs $12 a month. The fee is waived by direct deposit, which means it costs nothing as long as your paycheck arrives on schedule, which means the fee is a penalty for income instability disguised as a waiver for income regularity. The savings account pays 0.11% APY. On a $10,000 balance, the bank pays you $1 a year. The bank lends your $10,000 at rates between 8% and 24% across its credit products. The spread between 0.01% and 8% is the margin. The margin is not disclosed on the account opening documents. The account opening documents describe the features. The features are not the product. The margin is the product. You are not the customer. You are the inventory. The overdraft fee is $35. The average overdraft is $26. The fee exceeds the overdraft by $9 and generates $15.5 billion annually across the U.S. banking system. The accounts paying the most overdraft fees are the accounts with the lowest average balances, which are the accounts with the least capacity to absorb a $35 penalty, which means the architecture charges the most to the people who can afford it least, and the architecture has been operating this way for decades and has never been required to explain itself because explaining itself is not a regulatory requirement, and the margin it produces is significant enough that the legal exposure from occasional regulatory settlements is a cost of doing business rather than a deterrent. The hold time is 23 minutes, not because the bank is understaffed in absolute terms, because the staffing ratio applied to retail accounts is determined by the revenue per account, and the revenue per account at the retail level does not justify a shorter hold time. The representative who answers has a script. The script covers the 40 most common issues. Your issue is the 41st. The representative has no authority to resolve the 41st issue without supervisor approval. The supervisor is handling another call. You hold for 4 additional minutes. The issue is resolved. The resolution required 27 minutes and produced no revenue for the bank, and the bank absorbed the cost because absorbing it is cheaper than the alternative. The savings rate in 2023 is 0.01% APY at the major retail banks. The federal funds rate in 2023 is 5.25%. The bank borrows your deposit at 0.01% and lends it at rates between 7% and 24% depending on the product. The 524 basis point spread between the federal funds rate and what the bank pays you on your savings is not an accident. It is the retail deposit pricing model applied at scale to 40 million accounts, generating a spread that funds the institution's operations, its dividends, its share buybacks, and the private banking floor you do not know exists. The mortgage is a 47-page application. The underwriting takes 23 days. The rate is determined by a credit score model you cannot inspect, applied to a benchmark rate you did not negotiate, to produce a spread that represents the bank's margin on your loan. The margin is not disclosed as a margin. It is disclosed as your rate. Your rate is 6.875%. The benchmark is 5.25%. The spread is 162.5 basis points. The 162.5 basis points across a $380,000 loan across 30 years is $97,000. The $97,000 is the bank's margin on your mortgage. It appears nowhere in the closing documents as a margin. It appears as interest. The shift. The balance crosses $5,000 on a Tuesday. Not dramatically. A transfer clears. A position liquidates. The number moves past a threshold in the bank's internal segmentation system, and a flag appears in a database, and an assignment is made, and a call is scheduled. The call comes on a Thursday from a direct line. The voice is not a script. The voice is a relationship manager named Michael, who has reviewed your account history before dialing and knows the approximate composition of the balance and has prepared 3 things to discuss at your convenience. You have been a customer of this bank for 11 years. This is the first time the bank has prepared for a conversation with you. The first rule: below the threshold, the bank is not your financial partner. It is a utility that processes your transactions, borrows your deposits at 0.01%, and sells you credit at 24.99%. The relationship is not a relationship. It is a margin. The margin was always the product. You were always the inventory. The threshold did not change the bank. It changed your position on the balance sheet. The balance sheet was always the logic. It was never disclosed at account opening. The private banking floor has a reception desk with 2 people and no queue. The furniture communicates a different cost structure than the branch downstairs, not through ostentation, but through quality of material and absence of volume. There is no number to take. There is no screen displaying whose turn it is. Michael is already standing when you arrive because the receptionist sent a message when you entered the building. This is not courtesy. This is retention architecture. The $7,000 that crossed the threshold on a Tuesday is a balance sheet position the institution has an interest in keeping, and the keeping of it begins with the quality of the furniture in the waiting area and the fact that Michael is already standing. The fees disappear, not reduced, removed, no monthly maintenance fee, no overdraft fee, no wire transfer fee, domestic or international, no foreign transaction fee, no fee for the cashier's checks, the notary service, the safe deposit box. The fees that define the retail experience and generate billions annually from the accounts least able to absorb them are waived entirely at the threshold because the fee revenue is arithmetically irrelevant relative to the balance sheet value of the deposit. The bank earns more on one day's spread from your $7,000 than it earns in annual fee revenue from 40 retail accounts. The fees were never about the fees. They were about the margin on accounts too small to make the fee irrelevant. The deposit rate is 4.2% APY on the private banking money market account. The retail savings rate at the same institution is 0.01%. The difference is not a product feature. It is a pricing decision applied to a customer segment whose retention requires competitive returns. The 4.2% is not advertised. It is not on the website. It is not available by walking into a branch and asking for it. It exists in a rate sheet maintained by the private banking division and disclosed in a conversation with the relationship manager and accessible only through the threshold and the relationship the threshold initiates. The same institution, a different price for the same underlying product. The price difference is 419 basis points. On $7,000, the annual difference between 0.01% and 4.2% is $293,000. The securities-backed line of credit is extended at 65% of portfolio value. The rate is prime plus 0.75%, which in 2023 is 9.25%. The line allows borrowing against assets without liquidating them, without triggering capital gains events, without interrupting the compounding of the underlying portfolio. A $7,000 portfolio generates a $4,550,000 line. The line costs 9.25% on drawn balances and nothing on undrawn capacity. The product does not exist below the threshold. The product exists above the threshold because the collateral exists above the threshold. And the collateral is the balance sheet position the bank has already classified and is now willing to lend against because lending against it generates interest income while retaining the deposit that generates the spread. The bank earns on both sides of the same position simultaneously. The shift. The investment access changes at the threshold in ways that compound across decades. Private placements with $500,000 minimums, pre-IPO allocations through the bank's investment banking relationships. Alternative investment vehicles whose historical returns have exceeded public market equivalents by 200 to 400 basis points annually across 20-year periods. The access is not merit-based. It is threshold-based. The same investor with the same judgment and $400,000 cannot access the product. The same investor with $5,000 can. The threshold is the qualification. The qualification was always the threshold. The return differential on $7,000 compounding at 3% above public market rates across 20 years is $4,800,000. The $4,800,000 is the financial value of crossing the threshold. It does not appear on any document as the value of crossing the threshold. It appears as investment returns. The control mechanism is consolidation. The private banking relationship produces its full value when the assets are consolidated at one institution. The advisor coordinates across checking, savings, investment, lending, and estate planning when the assets are in one place. The coordination requires consolidation. The consolidation creates switching costs. Moving $7,000 requires liquidation decisions, tax timing decisions, new account applications, new relationship establishment, loss of the institutional knowledge Michael has accumulated about your position across 2 years of quarterly reviews. The service that retains you is also the architecture that makes leaving expensive. The retention and the service are the same product. The bank designed them together. Somewhere right now, someone is at a retail branch. Seat 12 in a queue that has been running since 9 a.m. The issue is a $35 overdraft fee on a $23 overdraft. The representative will answer in 19 minutes and will have a script and a supervisor and a time limit, and no authority to waive the fee without approval. The same bank, the same logo on the glass, a different floor, a different logic. Downstairs, the bank processes you and charges you for the processing and earns the spread on your deposit and lends it at 8% to 24% and calls the arrangement a banking relationship. Upstairs, the bank retains you and pays you for being retained and lends you money against your own assets and coordinates your tax and estate position and calls the arrangement private banking. The floor was always there. The number that unlocks it was always there. The bank knew the number before you made your first deposit. It has been watching the balance every quarter since. The balance crossed the number on a Tuesday. The call came on a Thursday. It always does. It always will.